Hi everybody, we've done it for fiscal policy. Let's do exactly the same for monetary policy, looking at key monetary policy themes in the UK. Because if you get an essay on monetary policy in your macro exams this year, you need to know what these themes are, apply this context really well, use stats and figures to back you up to secure the higher marks. And that's exactly what this video is going to do. But we know it's macro policy as a whole that's a hot topic area for exams this year. So make sure you've watched my fiscal policy themes video, you're watching this one, which is great, watch my supply side policy themes video, and watch my video about the UK economy overall and key stats that link to the UK economy. Then you have the full set, then we're ready for any question that's going to come up this year. But let's dive into it. Where are we with monetary policy? Well, from December 2021 all the way through to August 2024, the Bank of England was using contractionary monetary policy, very serious contractionary monetary policy in two ways. Significant increases in interest rates from 0.1% all the way to 5.25% at its peak. And at the same time using quantitative tightening, trying to reduce the money supply. So both significant contractionary monetary policies. And for what purpose? To tame and control, out of control, above target inflation. The increases in interest rates were very significant. All of 2022 and all of 2023, interest rates persistently went up by a lot, and in that very short space of time. They were held for a long time at 5.25% throughout 2024 as well. So this is really significant policy here. And yeah, for the main intention to tame inflation. Inflation was very, very scary in the UK, peaking at 11.1% in October 2022. But for many, many months, inflation was way above the target rate. For a good three and a half years, inflation was well above target actually. And the major causes of it initially were actually the huge expansionary demand side policies that were used during COVID times. On the fiscal policy side, yes, but also on the monetary policy side, in particular, the heavy quantitative easing that was used in 2020. £495 billion worth of new money was pumped into the UK economy via quantitative easing. These policies were highly inflationary in the aftermath of COVID lockdowns. But then from February 2022 onwards, the war in Ukraine, which drove up oil prices and fuel prices, which caused an energy shock, raising gas and electricity prices more recently, has driven up food prices significantly, became the major dominant causes of inflation in the UK. So in response, what did the Bank of England do? They raised interest rates in December 2021 for the first time in a long time, and then all the way through 2022 and 2023. And yes, inflation did come down. As I'm talking now, inflation is at 2.6%. But bear in mind, it took a long time for inflation to come down. That's the monetary policy transmission mechanism time lag argument right there. But also another evaluation point to consider, did inflation come down because of higher interest rates? Or did the Bank of England get lucky in that these supply side drivers of inflation started to ease off? Because bear in mind, higher interest rates don't control inflation on the supply side. They target the demand side of the economy by reducing AD and reducing demand pull inflation. But the war in Ukraine driving up all the prices I mentioned before are supply side causes of inflation. So yeah, did inflation come down because those supply side pressures eased, or because the Bank of England raised interest rates? I would argue it was more so the former, and the Bank of England got lucky that those supply side pressures naturally started to ease. Good evaluation right there. But there were other reasons why the Bank of England raised interest rates as well, and that is to reduce household debt and promote more household saving. Know that before COVID, household debt was rising significantly. Not surprising given that interest rates were essentially zero. It's natural then for people to go out and borrow money, take on more debt and spend that way. But that's not great for household finances. Any change in conditions or employment, households are then at the risk of potentially going bankrupt if they're overly indebted. And since interest rates have gone up, the amount of household debt in the economy has reduced significantly. The amount of household bankruptcies that have taken place has reduced significantly. That's a good thing for household finances and security. But also promoting more saving. That's a good thing. Savings are an important safety net for households in time of economic crisis and economic difficulty. But also savings are good for those who live off their savings, able to live off higher interest rates. Think of pensioners, think of the economically inactive, think of the unemployed. So a decent enough argument there, but also raising interest rates, normalizing them, getting them back to levels as we saw prior to the financial crisis means that only those people that need to borrow money and those that can afford to borrow at such high interest will do so, promoting more sustainable borrowing and sustainable lending in the economy, moving the UK economy away from a very heavy debt-fueled growth path, whether it's debt-fueled consumption or debt-fueled investment, to then promote economic growth. This is where we get more sustainable economic growth. That is consumption funded from savings, investment funded from profits, which is a healthy growth path for the UK economy. But also by normalizing interest rates, getting them to a relatively high level, a normal level, means the Bank of England have a meaningful place to cut interest rates from, to then stimulate aid and stimulate growth in times of need. And we're very much in those times of need right now. However, raising rates so quickly and by so much in a short space of time acted as a demand-side shock to the UK economy. These are contractionary demand-side policies. They definitely kept AD low, reduced growth and increased unemployment. We were in recession for a significant part of 2024, and I would argue that these policies were a dominant reason why. So the way in which interest rates increased very much was a shock to the economy, and they also harm living standards for the indebted, in particular households with high credit card debt, with high mortgage debt, suffering by having to pay back these debts now at significantly higher interest rates. In fact, for mortgage holders, higher interest rates increased mortgage repayments by, on average, £750 a month. That's a massive increase in monthly kind of debt payments as a result of higher interest rates. Not great at a time of the significant cost of living crisis already. Higher interest rates, yet another reason for businesses not to invest in the UK. Business investment has been shot ever since we voted Brexit. This is yet another reason for businesses not to go ahead with their investment projects. But also know that pushing interest rates up can harm banks. It can be very good for banks if they're able to attract more saving, given that interest rates are higher. But for other banks, there are concerns in three ways are linked to bank failure from higher interest rates. One is that if households, if businesses aren't able to repay their debts at high interest, there is a greater risk of bank insolvency. But two ways you can link to a liquidity crisis. If banks themselves find it harder to raise finance at high interest, there is a risk of liquidity issues. But also with higher interest rates by the central bank, it will mean higher yields for assets across the economy. So people are moving their savings away from traditional banks, chasing other assets with higher yields. It can then again mean that banks are prone to liquidity issues. So this actually happened in early 2023. Some smaller banks in the US went bust for these reasons, and that fed through to even banks across Europe like Credit Suisse going bust too. So systemic risk issues because of this bank failure is a nice point to make, if relevant, if an essay comes up about contractionary monetary policy. But that's not where we are now. Well, ever since August 2024, the Bank of England have been cutting interest rates. They've cut interest rates 4 times since then, from 5.25% all the way down to 4.25% as I'm talking now. And this is very much to lower the cost of borrowing for both consumers and businesses, hoping to promote more consumption, more investment, to boost economic growth by raising AD, reducing cyclical unemployment, promoting greater living standards, and trying to get the UK economy out of this stagnation it's found itself in for quite a few years now. And we are very much in need of this. It's very clear that the balance has shifted, hasn't it? Away from inflation control towards prioritizing higher growth and lower unemployment in the UK. And my personal view is that is the right move. And it's, I would say, even more right for the Bank of England to be more aggressive with their rate cuts. Some forecasters are saying that rates could fall to as low as 3.25% later this year, but somewhere in the 3 mark. So whether it's 3.5 or 3.75%, we can expect more rates to come. The inflation fight isn't over. There is a risk of inflation being re-stimulated, but I think that risk is quite low. As we're talking now, wage growth is still quite high, 5.9% in the UK, but all the signs are that the labour market is loosening and that it will continue to loosen as the year goes on. So wage pressures are likely to reduce. The risk of higher unemployment is a greater one, actually. So inflation risks from that side are naturally lessening. The supply side price pressures we talked about earlier are reducing, as well as are demand side pressures because of Trump, his trade war, uncertainties around Trump and his trade policies too. So I think it is right that growth and unemployment dominate policy making more so than inflation. So expect interest rates to be cut further, expect the Bank of England to be more aggressive with rate cuts. However, will this be effective in reaching the desired outcomes of higher AD, higher growth, lower unemployment? Well, know that consumer and business confidence are extremely low right now in the UK. So will consumers go out there, borrow and spend? Will businesses go out there and borrow and invest? Not at the moment. However, with further rate cuts, maybe that could be enough of an incentive to go out there and start borrowing to fund consumption or investment. But as we're talking now, this is a big limiting factor in these policies reaching their desired goals. So there you have it, guys. That is the current state of UK monetary policy. Great themes for you to then talk about in your essays, great stats for you to use as well in monetary policy essays if that's what features in macro exams this year. But you must complete the set. Watch the fiscal policy video, the supply side policies video, and the overall UK stats video. Then you're ready to go for whatever the macro policy question will be this year. But thank you so much for watching this, guys. Stay tuned to all the videos in the revision for 2025 exams playlist. I can't wait to see you in forthcoming videos. Thanks for watching.